Hi, I'm Thomas. This is the course Financial Institutions and Markets. Today we will be discussing market failure, financial crises, and regulation. Let's start our discussion by considering the impact, sometimes the negative impact, of financial markets in relation to society. Some people don't participate in the financial markets. This is the concept of financial exclusion. Some people don't have access to banking, they don't have access to credit, they don't have access to insurance, they're outside of the financial system. Another issue relating to society is household indebtedness, particularly in the Western countries. The trend over the past, let's say in recent times, the trend has been more and more debt relative to the asset base or the income level of an individual or family. People continue to build debt, and that puts them into a less stable economic situation, and that is the result of participating probably more than they should, to a greater extent than they should, in the financial markets. And part of that blame is on the markets for permitting these individuals and families to be able to access these high levels of debt. A third issue is fraud and scandals. When fraud occurs at a company, in particular at a public company, or some type of financial or corporate scandal that creates a loss for shareholders, those shareholders are people, they're individuals, they're families, they're investors, and those losses have sometimes significant negative impacts on individual and family financial situations. And then finally, market bubbles, crashes, and financial crises. We're going to look at one particular example up close, but first to address this concept. Market bubbles occur when there's some kind of unsupported attraction to a particular investment or type of investment or investment category, maybe the stock market in general, or it could be a particular company's stock, where people are investing not based on fundamental analysis, but based on emotion, based on the movement of the crowd. Those result in crashes when the market comes crashing down, when people realize that they were chasing a bubble, investing in a bubble, again, not based on fundamentals, simply based on emotion and perhaps some psychology. And financial crises, which occur as a result of individuals and institutions making financial decisions that aren't based on sound analysis, aren't based on solid long-term planning, aren't based on a consideration of potential downside. When people and institutions and an economy realizes where they've gone and what the real situation is, what the reality is versus what their faulty assumptions were, sometimes this results in a crisis. Let's look at one of those crises up close, the financial crisis of 2008. What happened in 2008? And this didn't just happen, it began several years before. What was driving this financial crisis? In this slide, we'll summarize 5 main points that we'll look at in detail to follow. Financial institutions created instruments they didn't really fully understand, and we'll learn about one of these financial instruments in our discussion. Lenders made loans which borrowers could not pay. Lenders became more and more aggressive in how they were willing to underwrite loans and what kind of borrower conditions they were willing to accept. And this went to an extreme. We're going to compare how loans used to be underwritten to how they began to be underwritten, and this was a significant factor in the financial crisis. Individuals bought houses they could not afford. Why would somebody do that? We'll talk about in more detail the motivations for individuals to do this, but they ended up in situations where they had home loans that they weren't able to manage based on their economic situation, their job, their financial situation, etc. Insurance companies, financial insurance companies, underestimated the losses. These were companies that were providing insurance in case there were loan performance issues, and the loan performance issues were so great they overwhelmed the insurance companies. And rating agencies accepted unrealistic projections. Rating agencies provide a grading or an evaluation of certain finance instruments, and in this case, the rating agencies were overly optimistic, didn't look closely at their assumptions, and were giving ratings that really were undeserved. Now let's look more closely at the role of financial institutions. A central financial instrument involved in the financial crisis was securitization. Securitization is a type of instrument that allows a lender to put a pool of loans together and sort of transform individual loans into a security that can be traded on exchanges. This increases liquidity and lowers risk, and as a result of the lower risk, the cost of capital goes down for the people utilizing this form of debt. What was the motivation to do this? Let's understand what was driving the financial institutions. It wasn't the benefit of society. It was additional revenue. They wanted to provide a new product to the market that would create additional revenues for the banks. That isn't in and of itself a bad thing, but they weren't doing this to improve society. They were doing this to improve profit at the investment banks on Wall Street. What was the accountability for the banks as it relates to this new tool, this new instrument, securitization, which has been around for many years, but in, let's say, the 2000s up until the financial crisis, began to be used much more aggressively than it had been in the past. The accountability was minimal. The investment banks didn't have their own money invested into these loans. They simply created a financial instrument, brought several parties together, collected their fee, and then went on to their next deal. So they didn't have any skin in the game, so to speak. Let's look at the role of lenders in the financial crisis. In the past, let's say before 2000, traditional loan requirements were that a lender would check on the employment situation of a borrower and verify the borrower's employment status and income level. They would check on the credit history of the borrower, and they would require good credit history to be able to obtain new financing to purchase a home. And the lenders would require a meaningful down payment, typically 20%, sometimes 10%, but typically 20% of the purchase price of a home would need to come from the pocket of the buyer. New loan requirements that became more and more common up until the financial crisis were no employment verification. Banks were simply accepting at face value what an individual stated their job to be and their income to be without verification. There were subprime credit options. Subprime means not good credit, so people that had credit issues were nonetheless able to get new financing to purchase homes. And lenders began to reduce the down payment requirement, eventually to the point where there was no down payment requirement, and sometimes even the home buyer could finance their fees as well. So they were actually borrowing the entire purchase price of the home and then an additional amount of money to cover the costs associated with obtaining the loan. So loan requirements became much more flexible, and lenders became much more aggressive in offering attractive terms with the goal of closing more loans, providing more and more financing. And another point about lenders, a key quality or a key component of the loan is the interest rate structure. In the past, home loans were fixed interest rate loans. Once a borrower closed a loan, their interest rate was set for the next 15 or 20 or 30 years. And then the concept of the variable interest rate came into play and became quite popular for home mortgages. And an interest rate which is variable could go down, which would mean a lower monthly payment in the future, or could go up. Interest rates could move up. That would mean a higher monthly payment in the future. And these types of variable rate loans were often structured with what was called a teaser rate or an introductory rate that was temporarily low for 2 or 3 years. And then there was an automatic reset that would adjust that rate up based on comparison to some kind of interest rate measurement in the market. There are several different options for what that interest rate measurement could have been. But the important point here is not which measurement were they using, but the fact that the lenders were setting the loan terms at an artificially attractive level for the first 2 or 3 years of the loan, and then the loan was adjusted to what typically ended up being a significantly higher payment for the borrower. Individuals also had a role. The borrowers themselves have some fault in what happened. One point is lack of personal financial accountability. They simply took the financing they could get without really thinking about whether they were able to handle that load of debt. A lot of the blame went to lenders for making the loans, or Wall Street for creating the securitization vehicle, or the government for not overseeing the situation. But individuals need to be accountable for their decisions, and a lot of people just took what they could get without thinking about the potential negative consequences in the future. Second, blind faith in the real estate market. The driver behind this continually increased lending was the continual increase in the value of real estate. And we're going to look at in a slide or two what drove those real estate value increases. But individuals didn't think about the fact that that might stop. They simply continued to borrow and believe that real estate would continue to go up in value, and it didn't. And finally, borrowing against real estate for personal expenditures. It became quite common to go to the bank with your home, which already had a mortgage on it, and ask the bank for an additional loan, borrowing against the value of your home based on an increase in the value from the purchase date to the time you were requesting that financing. And banks began to give those kinds of loans liberally, and people would then take that additional money, which meant more debt service, a higher monthly loan payment for the mortgage, and they were using that money for clothes, for vacations, for cars, and that eventually became unsustainable. People were buying things that didn't add financial value to their personal economic or financial situation. They were just buying things for personal enjoyment at the cost of increasing their debt burden, increasing the monthly payment on their mortgage, and this ended up creating or being a key driver in the financial crisis. The role of insurance companies. These are financial insurance companies. They're not providing insurance on houses or cars. Rather, they're providing insurance on financial products. So the insurance companies that looked at these securitizations, these financial instruments, evaluated the possible upside and downside performance of the instruments and said, we're comfortable providing insurance. We're strong companies. We have strong balance sheets. And if there are problems, based on our projections, what we think the potential downside might be, we can support the coverage of the losses of the insured parties in these transactions. But the insurance companies didn't do realistic analysis on the potential downside of these financial instruments. Losses were much greater than the insurance companies, or anybody for that matter, was expecting, and insurance companies could not cover all of the losses. They were overwhelmed. Additionally, there's a conflict of interest. When you're going to insure, if you don't agree to provide the insurance, you don't get paid. An insurance company doesn't make money unless they offer a policy, unless they provide insurance. No insurance, no income. That was a motivation for the insurance companies to say, yes, we'll provide insurance for these financial instruments. And finally, the rating agencies. The rating agencies give a grade or an evaluation to various types of financial instruments, and in this case, they were giving ratings to the securitizations. This is the pool of many loans into one security instrument that can be traded. The rating agencies, as did the insurance companies, failed to think about in a realistic way, with a realistic analysis, consider what might happen to these loan portfolios. How might they perform or not perform in the future? There was a conflict of interest with the rating agencies, just like there was with the insurance companies. No rating, no revenue. If a rating agency gives you a rating that you're not happy with, then you say, well, I don't want that rating, and you don't pay the fee. So there's a conflict of interest towards bias in favor of the party requesting the rating. The rating should be objective, but there's a bias to make that rating favorable so that the customer will accept the rating and pay the rating agency fee. And finally, there's a relationship between the rating agencies and the party we saw on the slide previously, the insurance companies. The rating agencies base their ratings in part on the fact that these securitizations were obtaining insurance. So they might have looked at securitization on its own and said, on your own, we're not going to be able to give you a good rating. But if you have a strong backer, such as a financial insurance company, then we'll be able to give you a favorable rating. And so the rating agency simply accepted the fact that the securitizations had obtained insurance and said, you've met the requirements, we'll give you a favorable rating, without closely considering what is the possibility that the securitization fails, and along with that, the insurance company isn't able to fully cover losses. The rating agencies didn't look at that closely enough. So why did it all come crashing down? Let's look at this in a summary perspective. Spending was based on debt. The economy was growing. People said real estate values are going up. New jobs are being created. There's economic growth. But that economic growth wasn't based on actual economic growth in the sense of new productivity, new technology. It was based on people borrowing more and more money to go shopping, to go on vacation, to buy new cars, instead of being based on the fundamental economic concept of growth. Quality economic growth is when technology allows for more productivity, training and education allow for better workers to do more and more with better quality in less time. That wasn't what was happening in this situation. Secondly, debt was based on increases in real estate values, not the fundamental economic concept of risk. A lender making a loan needs to consider the risk involved. And what was happening was lenders were simply looking at the collateral, the real estate, seeing the rise in values, assuming that rise would continue, and making a decision to lend based on the assumption that real estate always goes up, and it doesn't. They made the loans based on increased real estate values, not the fundamental economic concept of risk. And finally, increasing real estate values were driven by what? They were driven by more and more debt being available. They were driven by this availability of debt. People could buy houses with higher and higher levels of financing, requiring less and less of their own cash. That favorable financing acted as a complement to the home, and so the improved financing from the perspective of the borrower created an increased demand for houses. That increased demand, because houses take a long time to build, created an increase in home prices. But that wasn't based on some fundamental component or quality of the real estate itself. It was simply based on the concept of more debt available means more people are going to want to buy houses, and that increase in demand will drive up prices. And finally, let's look at the interaction between financial markets and government regulation. In a free market economy, individuals have the freedom to make choices that are in their best interest. At the same time, a free market economy with minimal oversight or no oversight provides the opportunity for individuals or groups to use manipulation to achieve gain at the cost of other individuals or groups, or more generally for a situation of excess to occur where people aren't using rational analysis and decision making, and a market goes to an extreme that is unsustainable. On the other hand, government regulation limits individual choice. You don't have as many options because of the limits put in place by the government. The benefit to government regulation is that it also limits the potential for manipulation and excess. There isn't one right or wrong position on government regulation. Some groups are in favor of heavy government regulation to protect individuals. Other groups are in favor of minimal government regulation to allow the market to have a hand in how the market works. Let individuals make choices that in the aggregate will drive the market in the right direction. So the idea that government regulation is good or bad isn't really a position that you can find universal agreement on. It's more a matter of discussing or thinking about what are the advantages and disadvantages of minimal or a high level of government regulation, and trying to find an ideal, a nice balance between no regulation and high regulation that makes the market work well, but also prevents the kind of crisis that we saw in 2008. This concludes the lecture on market failure, crises, and regulation. When we meet in class, we'll look at some of the real estate and financing transactions that were happening that led up to the crisis, and that will give you a good real-world perspective on the things that were actually happening that created this situation. I look forward to seeing you in class.